Hi, in this video we're going to take a look at some common trading strategies and the differences between them. Having a trading strategy is important for you as a trader because, when executed correctly, it can help you reach your financial goals. 3 of the most popular strategies are day trading, position trading, and swing trading. As its name implies, the day trading strategy focuses on buying and selling financial instruments on the same day. It's a form of trading that requires an ability to respond quickly to developments in the market. Typically, day traders open a number of smaller trades and will often use stop orders to manage potential losses that can occur. Position trading, on the other hand, is a strategy for longer-term holding periods such as days, weeks, or even months. The objective is to profit from a continuing uptrend or downtrend, almost like riding a wave. Position traders tend to open a smaller number of higher-value trades. Swing trading is a strategy that is implemented in an attempt to capitalize on an expected change of direction in the price of a financial asset. For example, a swing trader may learn from social media about trouble in Apple's management and predict that the company's stock will fall. In this case, they would open a sell position. Or, alternatively, they may read a news report about positive changes in the global energy market and assume that the price of oil will increase. In this case, the trader would open a buy position. Want to learn more about online trading? Check our website.